The stock market. Sounds intimidating, right? It's a place where fortunes are made and lost, where the stakes are high and the excitement is palpable. But don't let that scare you off. Like a scene from Wall Street with guys in crazy suits yelling, "Buy, sell." It can seem chaotic and overwhelming, like a whirlwind of numbers and frantic energy. Don't worry, it's not that scary. Behind the scenes, there's a method to the madness. It's a well-oiled machine with rules and strategies that anyone can learn. Think of it as a giant flea market, but instead of used furniture, you're buying and selling pieces of companies. Each stock represents a small ownership in a business. These pieces are called stocks. Why should you care? Because owning stocks means you have a stake in the success of these companies. When they do well, you do well, because the stock market is your ticket to growing your money. It's a powerful tool for building wealth over time, allowing your investments to grow and compound. It's how regular Joes and Janes like us build wealth. So buckle up, Buttercup. With a little knowledge and patience, you can navigate this financial jungle. We're about to demystify this whole stock market thing and make you sound like a pro at your next cocktail party. Imagine impressing your friends with your newfound financial savvy. Ready to learn how to ride this wild ride? Let's go! The stock market can be a roller coaster, but with the right knowledge you can enjoy the ride and come out ahead. First things first, let's talk animals. No, not those cute pandas at the zoo, we're talking bulls and bears. But why use animals to describe the stock market? Well, it's all about their behaviors. Bulls charge forward, symbolizing rising markets, while bears hunker down, representing falling markets. So let's dive deeper into what these terms mean and why they matter to you. A bull market is when the stock market is on fire. Prices are going up, everyone's making money, and life is good. Think of a bull charging forward with its horns up, unstoppable. Investors are optimistic, and there's a general sense of confidence in the economy. During a bull market, companies tend to perform well, and stock prices reflect that success. People are more willing to invest, and the overall mood is positive. It's a time of growth and opportunity. Now let's talk about the bear market. It's the opposite of a bull market. Imagine a bear swiping down with its paws. That's what happens to stock prices. They fall, and the market becomes sluggish. During a bear market, investors are pessimistic. They start selling off their stocks, leading to a further decline in prices. It's like that grumpy bear in your campsite, you just want to avoid it. In a bear market, companies may struggle, and economic growth slows down. People become more cautious with their investments, and the overall sentiment is one of caution and fear. Prices are falling, people are panicking, and it's generally not a fun time. But why should you care? Because knowing whether it's a bull or bear market helps you make smarter investment decisions. Understanding these market trends can guide you on when to buy or sell stocks, how to diversify your portfolio, and how to manage risks. By staying informed about market conditions, you can better navigate the financial landscape. Whether you're a seasoned investor or just starting out, recognizing the signs of a bull or bear market is crucial. It empowers you to take control of your financial future and make decisions that align with your goals. So keep an eye on those bulls and bears, and you'll be better prepared for whatever the market throws your way. Remember those stocks we talked about, those pieces of companies you can buy? Well, some companies like to share their profits with their stockholders. That's where dividends come in. Think of dividends as a thank you gift for owning a piece of their company. It's like getting paid just for being awesome. Now, not all companies pay dividends. Some reinvest their profits to grow even bigger. But those that do, well, that's just free money in your pocket. Dividends are like the cherry on top of your investment sundae. Section 4, Stocks, Bonds, and the Thrill of the Investment Ride. We've talked about stocks, those little pieces of companies. When you buy a stock, you're essentially buying a small ownership stake in a company. This means you get to share in the company's profits, but you also share in its losses. Stocks can be very volatile, with prices going up and down based on a variety of factors, including company performance, market conditions, and investor sentiment. This volatility can make stocks a thrilling but sometimes nerve-wracking investment. But there's another player in the game: bonds. Bonds are essentially IOUs issued by companies or governments. When you buy a bond, you're lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered to be less risky than stocks because they provide regular income and the return of principal at maturity, but they also tend to offer lower returns. Think of bonds like loans. When you purchase a bond, you're essentially acting as the lender. The entity that issues the bond, whether it's a corporation or a government, is the borrower. They promise to pay you back the principal amount on a specific date, known as the maturity date, along with periodic interest payments. This makes bonds a more predictable and stable investment compared to stocks. You lend money to a company or the government, and they promise to pay you back with interest. The interest payments, also known as coupon payments, are typically made semi-annually and provide a steady stream of income. This can be particularly appealing for investors looking for a reliable source of income, such as retirees. However, it's important to note that bonds are not completely risk-free. There is always the risk that the issuer could default on their payments. It's less risky than stocks, but also potentially less rewarding. While bonds offer more stability and predictability, they typically provide lower returns compared to stocks. This is because the potential for growth is limited to the interest payments and the return of the principal amount. On the other hand, stocks have the potential for significant capital appreciation, but they also come with higher risk. This trade-off between risk and reward is a key consideration for investors when building their portfolios. Stocks are like the roller coaster of investments. Thrilling, unpredictable, but potentially very profitable. The stock market can experience rapid changes, with prices soaring one day and plummeting the next. This can create opportunities for substantial gains, but it also means that investors need to be prepared for the possibility of significant losses. The key to successful stock investing is to stay informed, be patient, and have a long-term perspective. Bonds are more like the Ferris wheel, a smoother ride, but maybe not as exciting. While bonds may not offer the same level of excitement as stocks, they provide a more stable and predictable investment experience. This can be particularly appealing for conservative investors or those who are nearing retirement and looking to preserve their capital. By including both stocks and bonds in your investment portfolio, you can balance the potential for growth with the need for stability. Which one's right for you? The choice between stocks and bonds depends on your individual financial goals, risk tolerance, and investment horizon. If you're looking for high growth potential and can handle the ups and downs of the market, stocks may be a good fit. If you prefer a more stable and predictable investment, bonds might be the better option. Many investors choose to diversify their portfolios by including both stocks and bonds to achieve a balance between risk and reward. That depends on your risk tolerance and how much excitement you can handle. Ultimately, the right investment strategy is one that aligns with your financial goals and comfort level with risk. By understanding the characteristics of stocks and bonds, you can make informed decisions and build a portfolio that helps you achieve your long-term financial objectives. Remember, investing is a journey, and finding the right balance between risk and reward is key to enjoying the ride. Section 5. Mutual funds. Don't put all your eggs in one basket, unless it's this one. Don't want to put all your money in just one stock or bond. No problem, that's where mutual funds come in. Imagine a basket filled with different stocks and bonds from various companies. That's a mutual fund. It's like a one-stop shop for diversification. By investing in a mutual fund, you're spreading your risk and increasing your chances of earning a good return. It's like having a team of investment experts working for you. Mutual funds, because investing shouldn't feel like a game of roulette. Section 6. Tying it all together. You've got this. So there you have it, folks. We've covered the basics of the stock market, from bulls and bears to dividends and mutual funds. Remember, investing isn't just for Wall Street hotshots, it's for everyone. With a little knowledge and a lot of common sense, you too can grow your wealth and achieve your financial goals. Don't be afraid to jump in and get started. The stock market may seem intimidating at first, but with each step, you'll gain more confidence and become a savvy investor in no time. Section 7. Join the average Joe's journey to financial freedom. Want to learn more about navigating the stock market and making smart investment decisions? Of course you do. Hit that like button and subscribe to Financial Strategy for the Average Joe for more tips, tricks, and hilarious insights into the world of finance. Remember, investing is a marathon, not a sprint. So, put on your running shoes, grab your water bottle, and let's get started on this exciting journey to financial freedom together.